Hello everyone, I hope you are all good today and healthy. So today we're gonna start a new, actually there are two short chapters that we're gonna proceed with them. Today we're gonna solve them. On Wednesday we have the quiz. On coming Wednesday we have a quiz. For those who have missed the class and they don't have this information, it's the 2nd of December. And on the 5th of December, we have got the exam 2. All the necessary information are available here. You can check it if you have missed the class and you don't know what you should concentrate. So they're all here. The timing and the date. Okay. Talking about the dividends and share repurchase basics. All of you have already got the definition in the previous classes if you have taken in the principal finance, and I'm sure that you have taken it, that what is the dividend and what is the share repurchase basics. So the dividends are the amount of the money that is paid to shareholders as a compensation for the investment, for the risk that they take while being involved in a certain project. And share repurchases are the shares that are outstanding, that are traded in the market, they are purchased back to reduce the number of the share, to reduce the ownership pressure, and so on. So dividend is a distribution to the shareholders as a salary, which is declared by the company's board of directors and may not require the approvals by shareholders. Repurchase of the stock is the distribution of the cash when the company buys back its stocks or shares. So the board of directors, they determine the company's policy of the payouts. We know the net income, when they derive the net income in the company, when the net income is derived, okay? The bottom line of the income statement, net income is derived. This net income either will be paid as a dividend, part of it, and the remaining part will be retained in the company. And it will be as an additional to retained earnings, which is located in the balance sheet on the right-hand side under the equity side, okay? So if your net income is 100, the dividend will be, let's say, 30. That means the amount of the money that will be retained, that will be kept in the company, will be equal to 70. And the summation, the total sum of the amount should be equal to 100, actually. So this is payout policy, how much money will be paid to the shareholders, how much money will be distributed to the shareholders as dividend is determined by the board of directors, but it may change from one country to another country. It may require some approvals from the shareholders. So the cash dividend and the share repurchase are the methods. Both they're distributing the cash to the shareholders. Share repurchases may take the place for some reasons. The first reason that I already underlined, that board of directors may want to reduce the pressure from the shareholder side, okay, to reduce the ownership pressure. Because there are more shareholders in the company, there will be more pressure on the decision-making process. Another reason having the share repurchases in here is if you lack of some liquidity, if you lack some of money, and you don't know how to just finance this dividend payout policy, then you may need to use some share repurchases, like buying back the shares and giving them cash to satisfy somehow the shareholders. So this, The effect of this will have on financial ratios and the shareholders' investment returns. And the effect of this will be, of course, different on these two aspects. This distribution may provide as well the information about the company's future prospect. So it's informative action. So what do you expect from the company? If they distribute dividends, if they say we will not distribute this year dividend, and so on. If the company distributes the dividend, you may think that the company has got excess cash in hand when they just distributed it, okay? So they made a really good profit and now they distribute. And what proportion they distribute and what proportion will be remained in the company, you may get some information from that as well. Like thinking in the way that if the company keeps a lot of money in the company, that the money will be reinvested and a little bit less money was distributed as shareholders as a dividend, then you may think that the company has got really good future prospects, good future projects. So there are many information that you can derive it from this payout policy issue. So issuing companies cannot deduct the distribution to the shareholders for tax purposes in order to decrease the taxable income. This is another reason for the accountant they should take into consideration. So we will cover today there are different types of forms of the dividends. One is the cash distribution, the other one is non-cash distribution. So talking about the regular cash dividend and extra dividend and liquidating dividend, these three types of forms of the dividends that are based under the cash distributions, and non-cash distributions are stock dividend and stock split and reverse stock split. I'm pretty sure that you have already heard this terminologies before. So we'll revise them and have some information on that. Regular cash dividend is the cash dividend which is paid at regular intervals. So the regular intervals may be at any frequency, but the most common ones are based on the US and the Western countries are quarterly, semi-annual, and annually. And tendency of the companies to maintain or increase the dividends, these take the place as well. Often viewed that as signals the management assessment of the company's future. That is whether the company has maintained the dividend in the future. So you can just check it, whether the company is running the stable payout policy from the historical payment of the dividend. So companies prefer not to cut or to reduce the dividend. If you do so, that will show that volatility in the cash dividend payments. That means that the company is not stable. So the company is being involved not in a stable project. So some of the investors may prefer stable investment projects by certain companies. So this information can be derived from seeing the historical payment of the dividend. An extra dividend, which is another name is special dividend, is a dividend that is either paid by the company that does not pay dividend at all regularly and paid up by company in addition to a regular dividend. So motivation pay out the strong years without investor expecting an increase in dividend. We might think actually that there are many companies that has not paying at all the dividends. Okay, so first of all, I might ask you the question: what is the purpose of the company? I mean, what is the not the company? I'm sorry, I'm just using the wrong words here. What is the purpose of the investors? Why they need to buy a stock? First of all, who can answer me? Why there is a need to buy a stock? If you're an investor, put yourself to the shoes of the investor. Why do you think that there is a need to buy a stock or shares in the financial market of any company?
To make profit.
to make profit.
You
Okay.
lend money to company.
One more time, please. Last sentence.
You, for example, you lend money when you buy a stock or share. You lend money for your company to grow.
You lend it, but your main purpose is to get some cash on that.
Return.
To return. But does anyone knows how do we get this return? How does it work? Like buying the stock, okay?
There
Yeah,
are two ways.
Cash dividends and capital appreciation of the stock.
Yes.
Very good. Very good. This is what I wanted to hear from you. That, okay, that's underlines the main role or the main purpose of actually buying and or investing in stocks, like stock appreciation and the paying the dividends. But another question that comes into my mind, I'm sure that it comes to your mind, that I said that when I was giving the definition of an extra dividend, that is the dividend that is either paid by a company or that doesn't pay dividend regularly, or paid by a company in addition to a regular dividend. Okay, imagine there is a company that doesn't pay the dividend. Why do you think that the company might not pay the dividend? What might be the reasons not paying the dividend?
Maybe company is growing, and to those purposes they are keeping money.
Company
Maybe-
is growing and they're keeping this money for expansion their project, yes?
Maybe a company is reconstructing or reforming.
Companies reconstructing and reforming. What else?
Expanding size of business of company.
Okay, it has been already said that company is growing in expansion. So mainly, you might think that the company is reinvesting the money that has not been distributed as dividend, reinvesting in certain projects. It can be expansion project, it can be replacement project, it can be acquisition project, okay? The company might acquire another company and so on. So is there any example that you know the company, they don't pay the dividends? Any that you comes to your mind?
Maybe growing companies like Moderna and AstraZeneca, they are developing vaccine on coronavirus.
Yes.
And I suppose they do not pay dividends.
Do you suppose or do you know them, like it's for sure they don't pay it? Okay, let me
I'm
tell
sure
you.
they
The
do
one
not
which
pay.
is very, very famous, the one that you already know it, and you're every day in that, you cannot live without that company actually. It's in your everyday of life, that company. Who can guess what that company is that? Wherever you go, that company goes with you.
Apple,
No, not everybody is using Apple.
Samsung,
No, everybody, not everybody Samsung users. I'm saying that everybody in it, like 99% of the students, they're using that company's software.
Microsoft,
Microsoft.
Zoom.
One more time. So after the class or in the morning when you wake up, what do you check?
Moodle, Google,
From
Instagram,
your mobile, the first thing that you check, you wake up.
WhatsApp, Telegram,
WhatsApp. And more
WhatsApp.
Mail.
specifically,
message.
Facebook.
Facebook, WhatsApp, Instagram. isn't it?
Social network.
Yes.
No, I'm talking directly about the specifically about the Facebook. Facebook is the
Facebook,
company
yes, yes.
that doesn't pay any dividends.
Facebook owns WhatsApp. It's right.
Yes, Facebook owns the WhatsApp, it owns the Instagram. Okay, so it's the company, and this can be explained why the Facebook did not pay any dividends, because they purchased WhatsApp, they acquired the Instagram as well. Maybe they have more future prospects, like they're reinvesting their monies. So by buying the Facebook account, you might think to buy it with the only one purpose, if the price might go up, like appreciate. There's another one which is very famous one, Amazon is not paying any dividends, and Tesla. Everybody knows Tesla, yes? Have you seen the Tesla car?
Yeah.
So what is the
Yes,
benefit of the Tesla?
It's on like electric car.
Electric car. And what is said about the Tesla? Why there is a need to have an electric car?
Could you repeat again?
Why there is a need to have an electric car? What is the benefit of using the electric car?
It's better
Less
for
emission effect.
ecology, for
Less
environment.
pollution.
Yeah, less
Less
emission.
pollution, less emission. That's good. Do you know that when they produce the Tesla, they incur 10 times bigger pollution than any other producer of the car, any other manufacturer companies? So to produce the Tesla, it pollutes even more than, like approximately 10 times more than producing a normal regular car.
Is it?
Yes, it is. It was proven. However, the use of the car, the final use of the car is not that, it's not polluting at all. However, to produce that car, it's really huge pollution take the place. Okay, let us continue. Dividend reinvestment plan is a program that permits the investor to reinvest the cash dividends automatically into a stock of the issuing company. So the share provided in exchange for a cash dividend may be acquired in open market by the issuer or by a newly issued share. So dividend reinvestment plan encourages the owners with the smaller holdings to accumulate shares, allows to raise the new equity capital without any fluctuation cost, provides the opportunity to current shareholders. And however, it is really worthwhile to remember that the dividends are taxed when they received, whether they reinvested or not. So you will be taxed in any way. So there is a kind of double taxation takes place. Net income, before the derivation of the net income, it is taxed, and then it is distributed as a dividend. The dividend is taxed as well. Coming to the non-cash distribution, stock dividend is the distribution of the additional shares of the stock to shareholders on a pro rata basis, also known as a bonus issue of the shares, generally stated as percentage current shares of outstanding. Stock dividend does not change any shareholder's proportionate ownership, and shareholder does not receive any cash. And there are no tax consequences on the stock dividend. So this is the advantage of it. So more shares outstanding, and therefore potential for more shareholders. There will be more ownership. Lowers the stock price, which may take it more attractive as an investment. And of course, eventually there is no market value effect. There is no economic effect of the stock dividend. So instead of paying the cash, the company says we'll pay the stocks. Additionally, what you have it. Stock split is a proportionate increase in the number of the shares outstanding, stated in the following form, like number of the shares for number of the old shares, like 2 to 1, which means 2 shares for each share that you hold it. Stock split do not affect the dividend yield and dividend payout ratio. So accounting memorandum into no change in account. So the announcement in generally viewed as a positive signal here of the stock dividend. There is a reverse stock split is a proportionate reduction in the number of the shares. Reverse stock split has the opposite effect of the traditional stock split. It reduces the number of the shares with expectation that increase in the stock price, like 1-to-1. So it will be reduced 1 shares for the one who holds 2 shares. So the goal may be to increase the share price to make it more attractive for institutional investors. So reverse stock split are the most common for companies in financial distress. So here's an example of given about the stock dividend, how it works. Like imagine the stock dividend will increase by 20% on shareholders. How it will affect? Here the left side of the table is given already without any effect. Like shares outstanding, it was 1 million shares outstanding, earnings per share, stock price, total market value, shares owned and ownership stake. It says that stock dividend will increase by 20%, that you will add 20% more of stock. If there are 1 million of shares outstanding, you will add 20% more to it, which means just multiply by 1.2, it will give you 1,200,000 of shares. The additional number of the shares will be added here is 200,000 shares. Earnings per share is $1.5 earnings per share divided by 1.2. Earnings and the share amount, okay? Stock price, if it was 30, then it has been divided by 1 stock for each holder, okay? If you hold 1 stock, you will have 1.2 of stock, okay? By the share. Stock price, that will give you the stock price. Total market value. Yes? Any question? Total market value.
Microphone was on.
Okay. Total market value, 1 million of shares outstanding times by $30 by the stock price, which will create 30 million. As you can see, the economic effect is 0. The market value doesn't change. Shares owned 100, now is 120. Ownership value 3,000. Ownership value 3,000. There is a 0 economic effect. And ownership stake, the proportion of the ownership, the market share, is 0.01%. The same, 0.1%.
May I ask a question?
Yes, sure.
Why is it we multiplied by 1.2 at the beginning?
This one,
Yes.
because we said that 20% will be increased. So you can do in this way, like 1 million.
It's like 1 plus 20% multiplied by.
Yeah. Like 1 million and 20% of the 1 million is equal to 200,000. So 1 million plus 200,000 will give you 1,200,000. Or you can make it 1 plus 20%.
Okay. It's like growth. Yes.
Yeah, it's a growth rate. Okay. But it could be like, as it's given in the example of the stock dividend, it could be, where is it? Like 2-to-1, which means like holding 1 share, you will be given 2 shares, okay? For each share that you held before the split, the shareholder 2 shares after the split, okay? So it's a split. I'm sorry, I'm talking about split. Stock dividend is here. So stock dividend is how much the stocks additionally will be given to what you hold it. If you hold 20 shares, maybe given like 2 shares or 5 shares. So it will depend on the situation. And talking about the stock split, like impact, like 3-to-1, 3-to-2 of the stock split. So it was 1 million shares outstanding, stock price was 3, 1.5, 0.60, 0.60 over 30. It gives you the dividend yield, and price earning ratio is 31.5. And total market value is 1 million times $30. So when you do the stock split, you just increase the number of the stocks. Okay, increase the number of the stocks. One of the main purpose of doing this, it might to reduce the price, stock price. If it's 3-to-2, you use this ratio like 3-to-2. If you have 2 shares, you have 1 more additional share, which means in total you're gonna have 3 shares. Okay. So that will increase the shares number of the outstanding by 500,000, and it will reach in total 1,500,000. And stock price then will be reduced proportionally using this ratio 3-to-2. And earnings per share will be updated as well, proportionally will be reduced. Dividends per share will be reduced as well. And of course, dividend yields, like dividend over the price, will be same. As we said, there is no economic effect. Okay, economic effect will not be in the stock dividend and sorry, in the stock split and the stock dividend. There will be no any economic effect. So stock price tends to rise after the stock splits or stock dividend, because those are taken as a positive signal from the management about the future earnings, and all the investors may rush to buy it, those company stocks. If they report on the good earnings that doesn't follow the stock split, the price tends to revert to the signal, and stock split and stock dividends create more shares. They do not increase the shareholders' value, which means they do not create any economic value. However, they do affect the price. So paying cash dividend, so decreases asset cash and shareholders' equity return earnings. On the other equals, the decrease in cash will decrease the company's liquidity. So the ratio increase its debt to asset ratio. So while decreases the shareholders' equity, will increase the debt equity ratio. So stock dividends and stock splits and reverse stock splits have no effect on the company's financial leverage or liquidity ratio. And these transactions, they do not change the value of the company's asset and shareholders' equity. So they merely change the number of the equity shares. We have chronological situation in here of dividend payout policy. Give me a second, guys. Let me get a water. My throat is dry. Thank you for waiting. Talking about the declaration, date, ex-dividend date, and holder record date, and the payment date. These are the dates that we can say describing the payment chronology, the payout policy chronology, actually. So the board of directors, they declare the dividends on the declaration date. Okay, they decide we're gonna give this amount of money. So declarations actually specifies the amount of the dividend and the holder of the record date and the payment date in the declaration date. Holder record of date is the date of the ownership for determining who will get the dividend, who is entitled for dividend. Okay, so it is the date of the ownership for determining who will be getting the dividend. But when we talk about the ex-dividend date, it is the date on or after which the buyer is not entitled to the forthcoming dividend action. So this may be 1 or 2 business days depending on the market. So if you want to be entitled for a dividend, you have to buy the dividend on this day. So the difference between the ex-dividend date and holder record date is actually 2 business days. But it can be changed, okay? It can be changed. It can be 1, but mainly, generally, it is 2 days. And the last one, the payment date, is the date on which the dividend is sent to shareholders. The shareholders will receive this dividend. One more time. Declaration date is the date where the board of directors declare the dividends, and declaration that specifies the amount of the dividend will be paid to the shareholders, when is the holder record of date, and information provided about the payment date. Holder record date is the date of the ownership for determining who is entitled the dividend. The ex-dividend date is the exchange that determines the ex-dividend date, which is the date on or after with the buyer of the stock. If you buy on this date or after this date, let's say if it's like 2nd of December, if you buy on this date or after it, you will not be entitled for any forthcoming dividend. So this, if you want to receive the dividend, you have to buy the before of the ex-dividend date. You have to buy before the 2nd of December in order to receive any. So after that, the holder record of the date officially will be declared that this guy will be entitled to receive any dividend. And the last thing that I want to talk about the share repurchases is the transaction in which the stock issuer buys back the shares from investor, also known as a share buyback. So once the share repurchased and the shares become treasury shares, shares repurchased are restricted by regulation in some countries. And share repurchase provides, first of all, flexibility of the distribution of cash without any expectation of cash dividends. Tax efficiency when the tax rate on capital gains is less than of the cash dividends. And of course, the share repurchase is the important one. It signals that is stock which is being repurchased back is undervalued. So they will buy back now, after it will go in price up. So it's just kind of information that gives you, if you're a like potential investor, then it gives you a signal, then you should go and buy now in order to resell it later to make some markup on that. So there are some methods in the share repurchase, like buy in open market, fixed price tender offer, Dutch auction tender offer, and direct negotiation. So buying open market, you use the brokers to buy the shares, and method that provides flexibility for the company. Fixed price tender offer specifies the number of the shares and the share price, and buy the pro rata if oversubscribed. And Dutch auction tender offer specifies the number of the shares and the range of the price, and shareholders determine Dutch auction tender specifies the number of the shares and the range of the price, and shareholders determine the number of the shares they will sell back and specify the price within the range. And the direct negotiation is where you negotiate with a specific shareholder. Methods may be used to prevent any activist shareholder from getting on board, actually. So in here, I want to just underline what does oversubscribed means. You buy pro rata if it's oversubscribed. Oversubscription in here means that situation in which the investor show so much interest in new issue of the security, where we can say that demand is more than supply. So before a new issue, the underwriters, actually potential investor who may not book the order to buy the proportion of the new shares. So one thing that you should be clear in your mind that if there is oversubscription, that demand for certain shares is higher than supply. So the share repurchase and earnings per share, there are some example is given with the 3 different scenarios. GKL Incorporation planning a 100 million share repurchase. Okay, they're planning to repurchase 100 million shares back. So its current stock price is $25 per share. There are 16 million share outstanding prior to the share repurchase, and earnings shares per share without the share repurchase would be $3 per share. And what is the earning per share under each of these 2 scenarios? Actually, it's 3 scenarios, but it's 2. Anyway, first scenario, we use idle cash on hand, borrow funds after the tax rate, and borrow funds after tax rate of 15. So earnings per share price. Using the first scenario, net income will be equal is earnings per share without repurchase times the number of the shares outstanding. That would give you the net income. Then to find the earnings per share in scenario 1 is just the net income divided by number of the shares outstanding minus number of the shares repurchased back, which is 4 million. That would give you the earnings per share. So this is the aim to find under the scenario 1. First, you find the net income. Second, number of the shares, which is 16, number of the shares times the earnings per share without repurchase, $3. And we can see that earnings per share increased to $4 per share after the repurchase. At the end. So and second scenario, if we borrow the funds are used, like EPS after buyback, they give you the direct formula, like earnings minus after tax cost of funds divided by the shares outstanding after buyback. So net income is found in the same way, but we should take into consideration the funds that we borrowed. Okay, $3 per share earnings per share without any repurchase times the number of the shares outstanding minus 7% of after-tax rate borrowing funds, and you borrow $100 million. Okay, you borrow 100 million. And your net income will be equal to 41 million. So 41 million divided by number of shares outstanding minus the number of the shares which is repurchased back. That will give you the share repurchase. And borrow funds after tax rate becomes 15%. Same logic, like $3 per share times the number of shares outstanding and minus the amount that you borrow with the cost. So your net income is 33 million divided by, to get the earnings per share in the scenario 3, you should divide by 60 million minus 4 million, which is number of the shares repurchased back. And as you can see, 2.75. So the conclusion can be derived in here that if after tax cost of debt is less than earnings yield, which is 12% in here, as you can see, like $3, the stock price is 25, and to find the earnings yield is earnings per share without repurchase divided by stock price without repurchase. That will give you the earnings yield. So there's a conclusion that if the after-tax cost of debt is less than earnings yield, the earnings per share after the repurchase will go up. If after-tax cost of debt in the third scenario, is more than earnings yield, which was 15%, as you remember from the question, 15%. It is more than earnings yield, which is 12%. Then your earnings per share will go down after repurchase. But if after-tax cost of debt is equal to earnings yield, then your EPS will not be changed. This is conclusion. We can get it from the scenario calculation. So at the end of the chapter, there are some questions that you need to solve and practice. Okay, here. You just try to practice and solve them. There are 16 questions. If you have any questions, I will be very happy to help you. Okay, there's another example that comes that we need to go with. Do you have any questions regarding this? Using the basically three scenarios, one without debt, the other two scenarios with debt, but one which is higher than earnings yield, the other one is lower than earnings yield.
So after making 3 scenarios, we make conclusion, yes, overall.
Yeah, of course. You should have made conclusion that what happens to the EPS and why it happens. Okay, book value per share. There are some rules given to you that you need to take into consideration. Book value per share will decrease if share repurchase market price will be more than original book value per share. Book value per share will increase if the share repurchase market price will be lower than original book value per share. So example is given here. The share price of ABC and DEF Incorporation are both $25 per share, and each company has 20 million shares outstanding. Both companies have announced 10 million stock buyback. ABC Incorporation has the book value of 300 million, while DEF company has got 700 million. So calculate the book value per share of each company after the share repurchase. So share buyback for both companies, as given here, if both companies are planning to buy 10 million of shares with $25 per share, then they're about to buy 400,000 shares buyback, okay? Remaining share for both companies, 20 million minus 400, 19.6 million. So this much will be remain, this much will be bought back. But in total, there are 20 million. 20 million of shares outstanding, as you can see here. So computing the book value per share for ABC company and DEF company separately. So ABC's incorporation's current book value per share is calculated in this way, which is book value divided by the number of the shares. Book value is here for ABC, 300 million, divided by 20 million will give you book value per share. So the market price per share is $25, which is given here, and is greater than book value per share. So remember the rule. If the book value, if the share repurchase market price is greater than the original book value per share, then the book value per share will decrease. Look, $25 of share repurchase price is greater than book value per share, which is 15. So that shows the book value per share will decrease at the end. So book value per share, the book value after repurchase 300 million, and you repurchase 10 million of it. So that means the book value will be reduced by 10 million. So then book value per share equal to book value after repurchase divided by number of the shares outstanding after repurchase, which is this 14.8. So we can see that the book value per share after repurchase decreased by this amount, and it is consistent with the rule which was provided here. And we go with company DEF, DEF. Current book value per share 700 million. The book value divided by number of the shares, which is $35. So all the information is given here. 700 million. Sorry, 700 million. So we can see that 700 million divided by number of shares, $35, and then share repurchase market price is less than book value per share, the original book value per share. So going with the rule 2, which book value per share will increase if the repurchase market price is lower than original book value per share. So in this case, we expect that the book value per share after the repurchase for the DEF company will go down. So it will go up, because the market price per share is less. Share repurchase price is less. Book value per share, $690 divided by 19.6 million. So why? Because 700 million and we repurchased by 10 million, and the book value after the share repurchase is 690. Then book value divided by the number of the shares which is outstanding after the share repurchase, which is this, equal to $35.20. So book value per share increased by 20 cents, going in consistent with this rule, in accordance with this rule. So do you have any other questions? Please feel free if you have any questions regarding this calculation.
I have a
I
question
think-
regarding previous example.
Yes, please, let's go.
Could you go back?
Yeah, sure.
And conclusion part, I didn't understand. Where in this example is after tax cost of debt and earnings yield? Like how do we differentiate?
Okay, just a second. Earnings yield is here. That is calculated at the beginning, which is 12%. How do we calculate? We calculate like repurchase price divided by stock price.
Okay.
So the earnings per, I'm sorry, earnings per share divided by stock price. That will give you earnings yield. And we have a cost of debt Okay, we have cost of debt and earnings yield. If cost of debt after tax rate, the cost of debt is greater than your earnings yield, okay, which is 12% this, and if your after tax cost of debt is greater than earnings yield, then your earnings per share after repurchase will go down. If cost of debt is less than earnings yield, which is the case of 7%, 7% is less than 12%. So that will show that your EPS, your earnings per share, will go up. So that will make your EPS to go up. But if this is the case, this is 15 and this is 12. So in this manner, then EPS goes down. If this is the case, this is cost of debt. How much money you pay to borrow the money. Okay.
But it's like EPS in second scenario, it should go up, but we have 3.41.
No. Wait. EPS, that's true. Look, don't confuse. Let's go one by one. This is EPS, second scenario, 7%, yes? And our earnings yield is 12%, which is less. What we said, if cost of debt is less than earnings yield, your EPS will go up. Your previous EPS before the share repurchase is equal to
Okay.
$3.
Okay,
Now it's 3.41. If the cost of debt, which is 15, more than earnings yield, your EPS will go down, which is 2.75, less than 3.
Yeah, I got it. Yes.
Okay.
I thought like initial EPS is 4.
Okay, great. Do you have any other question?
I don't have. Thank you.
Okay, you're welcome. Any other questions, guys? If you don't have any questions, let me take attendance. And you may not, don't tell your friends to enter to take the attendance because I just locked the Zoom. Nobody can enter. I'll take the attendance and I'll let you go. Sanjar? Islam? Here, he was laughing. Aiday?
I'm here.
Yasmin?
I'm here.
Jean?
Professor, I'm
I'm
here.
here.
Sanjar,
Ram is here.
Okay, Sanjar, you're here.
Yeah.
Okay, I can hear you. Okay.
Mm-hmm.
Yasmin, Jean here. Nias?
Yes, I'm here.
Tamiris?
I'm here.
Yerzat?
Here.
Gabdulgani?
Here.
Raushan? Binura?
Here.
Aydana? Begzat? Here.
I'm
Zirui?
I'm here.
Sultan? Sultan? Daujan?
I'm here.
Eldar?
I'm here.
Aydos? Gani, Artur, Aziz,
I'm here.
Baglan, Oktamov,
I'm here, Professor.
okay, Zarina,
I'm here.
Abdurrahim,
Here.
Raihan,
I'm here.
Alibek,
I'm here.
Daniar,
I'm here. I'm here.
Sanjana,
I'm here.
Dalirhan,
Here.
Baglan,
I'm here.
Milana,
I'm here.
Milana,
Yes, I'm here.
okay, thank you. Just voice didn't come, that's why properly. Arnur,
I'm here. I'm here.
Ilya,
I'm here.
okay, Daniel,
I'm here.
Vladislav,
I'm here.
Diana,
I'm here.
okay, Clementi,
I'm here.
Janelle, Camila, Adilhan,
I'm here, Professor.
okay, Adilhan is here, great. If you don't have any questions, thank you so much. Wish you good luck in your quiz and the exam.
Thank you.
Thank you.
Thank you.
Bye.
Bye, take care.
Have a nice day.
You too, guys.